All right, what's going on, everybody? Big inflation data again today. It's very likely that the muted reaction we saw yesterday was due to the fact that we had this today. We've already started to see them hedging, and that reinforces the idea that today's data is more important than yesterday's, at least in relation to what the market is looking for, right? Um, we're going to get to how we can see that, but it's there. I'll show you. So they are hedging. They are worried about today's data, and that implies we're very likely going to get a liquidity gap set up, or at the very least, what I like to call an event candle. So at 8:30 on a 5-minute chart, let that 8:30 print close, and then mark that candle out and use it for guidance within today's trading range until we leave that zone. I seen a post here. Nomura's McElliott says 75% of the SPX will be in blackout by October 6th and 75% of market cap by October 2nd. Now, we've had a lot of buy support, right? The buy side of the market has been phenomenal all year. If they're going to go into blackout mode and we don't get their supportive buying flows, that doesn't mean we're going to crash and burn, first of all, right? That's not bearish by itself. It's just a lack of buying support that we've had all year, right? At least put that into context, right? After April 9, when the president capitulated to the bond vigilantes, since then, we've had a lot of buying flows. And without it, it will be easier to see this market go down. We've seen time after time this year where the lows were challenged and were just bought right back up again. They were defended over and over and over by this large amount of capital being put into the market. Without that buying support, we could actually see a market go down a little bit. And we're not talking about the 2022 bear market, where we dropped a couple hundred points to the downside. We're talking about just, maybe getting down to that 50 period moving average and getting underneath it a little bit. Certainly not expecting the 200 period. I think that puts us into some more systemic weakness, and it wouldn't be from this, right? That would be from data and other sources. So it's a pretty good number. Really, all things considered, it shocked me that it was that high, but well, now you know. And we got that out of the way. The GDP Now tracker, which, by the way, you can get that on your phone. There's this really great app, and it's free. I think it's called Econo Now, and I'll check to make sure that that's what it's called, and I'll send you a picture of what it looks like. It doesn't cost you anything, and it doesn't bother you, right? It just stays quietly in the background until you tell it you want to hear from it, which I love that. So you can always keep track of this Atlanta Fed GDP Now tracker, nice and easy on your phone. There's a lot of apps for phones and tablets that work really well and that are free. And that's, if you don't have it, well, we're going to get you hooked up. Green on the screen around the world does give us the implication that everybody assumes we got the numbers. Now, I'm a consensus person. So if 90% says it's good, it's probably good. But herein lies the rub. If they're wrong, and they've been wrong before, everybody's going to be off sides, and it's going to get really nasty really fast. If there's nobody buying and everybody selling, then you got to chase just to get your fill, and people will jump all over themselves, right, to hit below the bid, and then it's just going to get nasty. I can see that Liz Ann Saunders is out there putting out some work. If you guys don't follow her on Twitter, man, you're missing out. That lady is prolific, so it's hard to keep up with her sometimes, but she always has really good stuff. She's talking about PPI right now. Probably just flexing before the numbers we get today. So Hong Kong basically flat. Canada's up the most, but I mean, really, no offense, but who cares? It's Canada. Europe, Japan at a half. Then the NASDAQ doing the best for the US, just more than a quarter. S&P, Dow, and again with small caps dragging its feet. Yeah, eh? These numbers are a little off, 0.2 to 0.3 and 2.7 to 2.9, but not really thinking this is going to cause a lot of violence by itself. The fact that they're hedging kind of gets my attention, right? If everybody was so happy-go-lucky that these green prices imply here, that, you know, we're all in the know and we're all on the right side, why are they hedging? We're also going to get some job numbers today. This isn't the numbers. This is just some numbers. And they're not that far off, not expecting anything out of that either. And all of it is from 8:30. Then we'll get into the budget at 2, and that's just, you know, pantomime. And that'll wrap us up for the week. Remember, this is the last week of the contract for the ES and the NASDAQ. Next week, we will be on the new contract. The old one will still be there, but you don't want to be trading that one, right? You want to make sure that you update if you have to manually roll your contracts. If you're letting the platform do it for you, TradingView is very likely going to be rolled by the time you come in tomorrow morning. And then Thinkorswim will be rolled by the time you come in Monday morning. So just, you know, be prepared for that. All right, well, we got an ECB press conference also today. So at 8:30, we're going to get our data. And then at 8:45, they're going to start chipping teeth. I don't know how much influence this is going to have on us. We'll have to just play it by ear. But the main thing is that you know what's happening, right? So that you can be prepared for it. It's at 8:45. We've got the 30-year bond auction at 1 o'clock. So that's a really big deal. 8:30, 8:45, and then 1 o'clock today. The nat gas, who cares? Right? It's nat gas. What a joke. And then we got Adobe after the close. And remember, that's one of the NY Fang group names, Adobe. They got such a push when they announced that they were going to adopt AI. And then they just butchered it so bad and they got slaughtered in the charts because they weren't able to monetize and they spent just a boatload of money. Looks like they're trying to turn things around a little bit. We'll see if they actually made any money after spending. And everybody that I heard from said it was just a nightmare. They had all these different subscription tiers. Everything you tried to do popped up another pay now, and it was just horrible mess. I don't use Adobe myself, more of an AutoCAD person, but to each their own. See, they do a really good job of communicating their expectations for Fed policy. Remember, we're going to be seeing ECB press conference today with Christine Lagarde, but they've already laid out what they're going to say. So their forward guidance right now is really well. And it's not to say we never give forward guidance, but we've been in a regime where we've been, quote, playing it by ear, and we haven't had that forward guidance. but they've been in a regime where they're laying it out nice and clear in advance. So anticipating to hold interest rates unchanged and no additional cuts this cycle. Everything else is just going to be her chipping her teeth. So we'll see what goes out of that. That's wild. This is CTA positioning in the SPX, and it's just really stretched, right? Now, at some point, that's going to pull back like it did here when it was really stretched and then it pulled back. But that by itself doesn't mean we're going to, dump. We could pause. If we look at the way the S&P dealt with that, it was just a slight pullback, but it was still a higher low. We could get a pullback here, and it could still be just a higher low in the SPX. But what that does imply is if you're in long calls, that you might want to take profit before it starts that pullback, because the pullback will not be nice to your long calls. And then the NASDAQ, I don't know, it kind of feels a little more stretched than the SPX. But either way, we're still going to be looking for a pullback, and it doesn't have to, right? That's kind of the crazy point. Look at this wild run here, and it didn't have a significant pullback in that wild run. So now that we've got this run here, it doesn't have to pull back. But if you put that in with what we saw from McElliott about the October 2nd and October 6th, then you're going to have to, start to consider things are going to get a little weak. We're going to lose a lot of that buying service that we've had. This is how I know they're hedging, right? So it's not my opinion. I'm not guessing or assuming that they're hedging. They're hedging. And don't get me wrong, they're always hedged. You don't drive your car around without insurance, right? But if you know you're going to take your car out to the Derby, dirt track, rocks getting flown around everywhere, maybe you get some extra insurance. They are picking up additional insurance this morning, and they did not do that yesterday. Now, I mentioned measuring the event bar. We got a really good example from yesterday, so we're just going to use that for my example. This is not a liquidity gap play that I would want to trade because, as I've mentioned before, we don't want a wick on the downside, and we want it to close in the upper 25 percentile. What I mean by that is if we think about a dollar bill, right? Dollar's got 4 quarters in it. Candle's got 4 quadrants to it. You got the midline, and then you've got the 75% and the 25% down here at the bottom. So if you have a bullish bar, it should close in that upper 25%. If it was a bearish bar headed to the downside, we'd want it to close near the very bottom. We don't want much wick on the other side, and we don't want any wick on the starting side. So this was a liquidity gap, but it's not one that I would want to trade because it didn't form the way I like it. Still, we can use all of this for analysis. One thing you want is where we opened. Always mark that one. That's really important. The next piece that you mark is the entirety of the candle, all of it. And then you project from that 50% higher and 50% lower. We use 50s because of the extra excitement of the candle that's being played, right? When you're dealing with event volumes, price can get really wild. And if we had the candle form and then we broke out and started to run, it very likely would have made it to 50%, like it did last week when we had an event bar. But once we got into the RTH yesterday, this bar and its measurement wasn't very helpful, right? Because we were inside of that bar. It wasn't doing us any good. So seeing that it wasn't helpful, took it off and traded without it until we got to the edge of that bar, which is the bottom down here. I had somebody ask what I mean by the edge. Where the stop is, right? Where the cliff edge is. There's no more land. Well, in this case, there's no more candle. The edge. So once we break that low, then we can put the drawing back on because it's going to have some value to it. And you can see that price responded to that low. Price also responded to that open. You want both of those levels, right? You want to know where price is going to hit. So once we got the breakdown, we can reapply the drawing to the event bar. And there's your 50% of the event bar. But there's also your 111 tags where it paused and the 1, 2, 3, 6 where we got the OCC, which is the opposite candle color. This bar gave you everything that you needed. All right. So event bars have value to them. Even if this didn't give us a gap close play, which, all things considered, you could have played the gap close. But it gave us levels to be mindful of through the intraday, and they worked perfectly. So at 8:30 today, we're going to get an event bar again. Maybe it's a liquidity gap bar, maybe not. But either way, whatever bar we get, lay your levels out from there. And if we're sitting inside of it and we're not going anywhere, then, take it off once we get into the open and deal with price within the open until we challenge the edges of that bar. Then reapply your drawing on that. Cool, cool. Keep your eye on the market maker move. We're making an assumption that they are hedging due to the event at 8:30. That's a pretty safe bet, right? All things considered. But what if we're wrong? What if they're hedging for some entirely different reason and it just happens to coincidentally show up on the same day that we're having this event? So, I'm pretty comfortable in my assumption that they're hedging because of the 8:30 event. But after 8:30, if this doesn't start to fade, then that says, hey, we're wrong. They're hedging because of some other reason. This has a lifespan of today only. So throughout the afternoon, even if it did stick around, it would start to fade because, well, it's going to die at the end of the day. But it should already start to fade after 8:30. And especially if we get into like the 9:30 open, I would be surprised if it hadn't got cut in half by then and was almost gone. So we do want to see that start to fade out. Otherwise, it begins to imply that they weren't hedging because of 8:30, they were hedging because of something else. We are still inside day, by the way. So until we get outside of yesterday's price, we don't really have anything else. Let's update the spot gamma levels. Looks like the put wall rolled down again. Let me check that to make sure. At first glance, that is what it seems. Nope, 63 is where it was yesterday. So it's back down to the low that we've been seeing it rolled to since mid-August. It got to 6,300 on 8/20, and it's moved up and down off of that level since then, but it doesn't go below 6,300 at this point. So if things get nasty today, we've got the 3-period moving average, 65.32 cog line, then the 10, then the 3-week. And the 3-week is just underneath the volatility trigger. But we are a long ways from zero gamma, so we're not expecting to see the dealers change their hedging dynamics unless things just get really nasty. Volume's kind of light, sitting at 42. but we understand why it's light because we've got 830 print. If we had come in this morning and we saw it was in the 40s and we didn't know that there was an economic event, we would want to go looking around and find out why it is so light. But we already know why, so it's not a big deal. That's the way the system is designed, right? The low volume is a warning. The hedging label is a warning. So that if we didn't have an economic event and we saw these things starting to populate on the chart, we'd know that we're missing something. Even if we didn't know what it was, we'd know, hey, something's wrong. The market's skittish. It's sitting out and it's hedging for some reason, and we'd want to know why. We are closer to the upper ADR than we are the lower, not by much because we're only up a little bit, but we are up, and it's unlikely that we're going to reach that ADR before 8:30. So the ADRs won't be in play until after we get the event bar and we figure out where that's going to be. Yesterday was an MDP. That's a missed daily pivot. We challenged the channel on that pivot yesterday afternoon, but we wasn't able to break it and keep it. But we've already hit today's pivot. So, we won't get consecutive missed daily pivots. Today's pivot is higher than yesterday. That's bullish. Price opened underneath it, and that's bearish. Those two incidents kind of cancel each other out. We dealt with the floor pivot, meaning we've interacted with it and we've expanded away from it. Now that we've left that zone, if we come back into it, we expect to see a response to it. And when we're here, we can just cross back and forth all we want. It's not expected to be supportive or resistant to the market. But now that we've left the range, if we come back in it, we expect to see more of a response there. Also, if we do come back into it, we want to focus on reciprocation. Whatever we got on this side, we would expect to get on this side. So it looks like we went, let's just round up and say 15 points above. We would look for 15 points below. Reciprocation. All things considered, we did expand a little bit yesterday. So we want to see what the SNR levels are for today. And we almost got to R2 yesterday. It's impressive. Almost. Wink and a nod. So we can see that the lines are more narrow today. This is S3 and that's S3. Obviously, they're a lot different. Today's is more compressed as a range. We can get to R1 easier since we're almost there. 65.60 and 65.17 for S1. If we can get above R1, it's likely that we can go to R2, right? But we got to get above it and keep it. And if we break the floor pivot and our own Globex low, 65.32 cog line, then we want to focus on yesterday's low and S1. Level by level, run it down, right? All right, so we're starting to develop a second distribution. We don't call this a capital B profile, right? It's a 2D profile or a double D. There's a profile D shape here, and there's another profile D shape here with the point of control in the lower D. You can have a lowercase b, or you can have a capital P, or you can have a capital D. And if you have a capital D, you can have two Ds. Still doesn't make it a capital B. So the point of control hasn't moved up yet. We're putting in a footprint up here, but we haven't yet been able to move that point of control. That's what we're going to be looking for throughout the day today. and see if we can find this point of control up here by tomorrow, which would be a significant change because we've been in this range where the point of control's been holding really steady. And this will be a higher point of control than any of the others. It also continues with the higher print in the point of control that we've been seeing since mid-August. This one was higher than that one. This one was higher than that one. And so far, this one is higher than that one. If it moves up here into the 65.40 area, that's going to be a significant change. Otherwise, if we do break to the downside today, 6,500's got the point of control. So we've got a lot of structure down here. We've left some footprints behind. We want to see this slow the move down. It doesn't have to stop price completely. But if we challenge the low of the week today, we're going to be looking for a 111 or a 1236 outside the lows of the week. That gives us 64.80 and 64.70. And those companies are not in blackout period yet, right? That'll be as we get closer to October. So if we do head to the downside, we're still expecting that buying support across the markets, not necessarily in the indexes. 10-day, 30-minute volume profile and TPO still don't have any idea where the new point of control is going to be, but we can see the discrepancy between the TPO and the volume profile. It's suggesting we're going to see the point of control roll down to 64.68. We still got to see it play out. We're taking candles off on the left for every new candle we get on the right. And we haven't sat still long enough to build out a new high volume node. So not telling where it's going to go at this point. We didn't get a new VPOC from yesterday because we opened on it and then we've crossed through that level multiple times. So that's done. But we still have the previous points of control. If we break yesterday's low, we've got one at 65.15. Look at the volume coming in today, or the trading activity across that high. Remember what we've talked about when it comes to these high volume nodes at the highs. If you have price run up and it gets up there and you don't see a high volume node across that high, then you didn't run into a bunch of sellers at the top up there. You just ran into buyers that got exhausted and it faded away. But you do have a lot of trading activity right here. Right on that line. 65.53. It's not even on the big round of 65.50, which is actually shallow. It's all the way, it's this shallow area here. Keep in mind, we can move through shallow areas really fast, right? So if we do start to break down, we could just drop right back down through that shallow zone because shallow zones don't have any footprint to it. It also lines up with that high volume node from yesterday. We had another one here. It's not perfect right on the line, right? But that's the way markets work. It's not to the tick science. That is a lot of work they put in last night. We've got three distinct distributions with the point of control around the 50% mark. If we was to measure this whole thing, it lines up right on the midpoint of that range. All right, we made it to the edge of the weekly expected move. We broke it, came back in. Now we're challenging it again. This range is what we expect to make for the entire week, and it's what we expect to close inside of at the end of the week. Well, that doesn't mean that we can't get out of it, before the close on Friday, as long as we come back in by the close of Friday. And there's a 30% chance that we close outside of that range anyways. If today starts to get ugly, there is a good argument that we can be at the other side by Friday close. I know this seems like a long way to go, but really it's not. And there's plenty of examples where we can make the whole trip in a single bar. This one at least made it back to Friday's close plus some. But if you was to go back and look, there are plenty of examples where we made the whole trip from one side to the other in a single day. Here we did it 3 times in a row, but that one looks a little janky. And that was the April capitulation. Still, we can do it, right? And we're talking about a 2-day move because we'd have all day today and then all day Friday to get it done and close at the lows tomorrow afternoon. Now, I'm not saying that's what we're going to do, but if things turn ugly today at 8:30 and we start to break down, there's this logic that talks about where traders would put their stops, right? Just kind of follow it through. So if this was stock and you get a group of traders who went long yesterday, where would they put their stop? Below the low of the day, right? So there's a consideration that there could be a lot of stops just underneath that line. And of course, the day before, same thing. If we had a lot of traders that were going long on that breakout, for an example, where would they put their stops? Just below that low. Then the same thing here. So if we were to start breaking down and we get into these stops, well, they're longs. These are long trades. Those stops are sell orders. That adds to the selling. We get more selling. It picks up speed. We make it to the next spot. We break that line, run into more selling, which adds to the selling. We keep going, get this line. You get the idea, right? On down we go. And then it's just a chain reaction. The same thing can be done to the upside if we were doing that same analysis. And this is the outcome. This is exactly the kind of focus that you get from that sort of a move. Put that same theory into play. We broke that high. We ran into the stops for those shorts, which were buy orders. That added to the buying. We continued to push, hit the stops from this level. That added to the buying, continued the push. And the TRB made it all the way back to the top by the end of the day. It's why the TRB pattern is so awesome, because it's a one-day wonder. Well, it can work the same way in the other direction. $64.88 is Friday's close. That would be target 1. And then $64.25 is the low of the week. That would be target 2. We don't have any expectation that we're going to do that, by the way. I'm just saying, if we do start to get ugly, that's what you want to target. And you can use that low for any market, right? If we were to put Apple, Microsoft, QQQ, whatever, put the weekly expected move on it. If we're at the edge, on the upper edge today, and things do start to get nasty, just focus your options on the other side for Friday's close. We're still above the 10-week, and we're easing our way back up a little bit. This is not overbought. It's not overextended. Everything is fine. There's nothing wrong here. We're in a good, healthy market backdrop, and that's what this is telling us. So all systems normal. We're good. Looking at the 10-day, we're not even at 1%, so we're not getting stretched on the shorter duration time frame. Everything is healthy. It's good. It's just solid. There is no warning signal here at all. Now we can look at things that are up this morning, but really it's the 8:30 print that we need. So we already saw when I started the stream that we were systems green across the board around the world. Everything was green. China's up 1%. The Mag 7 up volume is up more than 3/4. China again, China again. Bitcoin, quantum and chips and airlines are up. They're not up enough. And I tell you, I want chips up if we're going to look for an extended rally today to get a breakout to the upside and continue to move. We need chips. If we don't have chips, I don't think the move is going to do much justice unless we get some 0-day flow in, and we can't see that in the pre-market, so we wouldn't know if we were getting it anyways, right? So without chips, I'm going to have to see some serious 0-day options flows to give any consideration to a clean breakout to the upside. And by breakout, I mean get above yesterday's high and expand into that 6,600. Because if we get a breakout, that's the target for me today. I just don't expect that we're going to get that, right? Then there is the consideration of the week's pivot point, right? This line way down here. Let's jump back over to this one. We didn't talk about it. We are a bit away from that weekly floor pivot. Now, if we opened that high on Monday, I would have, pretty high conviction that we weren't going to go very much farther to the upside because we'd already exhausted how far away we were from the weekly pivot. But we didn't open there on Monday, right? We opened really close to it and we've been driving higher away from it all week. Now the concern is how far away we are. I've done a lot of measures on this of how far away can we get from the weekly pivot before we're, quote, too far. And what I found was it's subjective. If we're in an environment where we're expanding away from it a lot, say in a really bearish market environment, we're making big daily moves and we are expanding away from it consistently and often, then we can get 2.5 to 3% away. But if we're in a less violent environment and we're not making big moves away from it on a weekly basis, it tightens up to about 2%. Well, we're at 1.5% looking at yesterday's highest point. We made it 1.5% away from that weekly pivot point, which means we don't have much upside left on the week before we start to get too far away from that weekly pivot. Now, that wouldn't cause us a reversal by itself, and it doesn't imply that we would go down, just that we would really struggle to go higher than that 2% mark. So if we get an upside breakout today, and I think that 66 is on the table, I don't think we could keep 66. You know, in the videos when the guy bungee jumps and it stretches and stretches and stretches, and then he kind of just pauses down there at the bottom before it yanks his butt back in the other direction, that'd be 6,600 today, right? That we get just there on the edges and we kind of pause there before going back in the other direction a bit. I think that analogy kind of works. It's either that or Wile E. Coyote, right? When he runs off the cliff and hasn't realized there's no ground underneath him yet. But then that would just, sound old. So this morning, keep your eye on those chips after the 8:30 data. And looking at what's down, I mean, we've got crude, gold, silver, so precious metals, miners, but the metals and miners, they're not down enough. At least silver's not. GLD is down more than 0.5%, so that counts. And gold futures are down. But the miners like GDX, it's not down 0.5%, so it's not there yet. And we've got solar leading. You don't want solar leading for a breakout in a rally day. That's just not that's not what you want. So chips, we want to see more out of this. We want it up at least 0.5%. The Mag 7 group needs to be up 0.5%, and it's almost there. It's getting there. It's really close. Generic tech at 0.5. China's at 0.5. Bitcoin, and then China again. So, we're moving in the right direction with the right stuff. I'd like more out of finance too. But if we start to lose these and they flatten out, start to turn red, we can't rally if we don't have chips and mags and tech, right? Can't. 0-day flows alone won't be enough to get it done. So you got 20 minutes. Look for that big event bar. Measure it out like we talked about. And if it's a gap close setup, I'll post it in the chat that it's a gap close setup. But it's pretty obvious if it isn't, because you'll have those big wicks on each side, and that's not what we want, right? Especially on the starting side. It's got a big wick down here. So we know that that wasn't a gap close play because of that big wick. I know it doesn't look big in now when I zoom in on it, but it's not what we want, right? Just because we wouldn't trade it as a gap close doesn't mean we can't use it for analysis of a gap close. And it did. It went right down there and closed it just pretty as you please. But it wouldn't have been tradable. And it showed how, as a gap close play, you wouldn't have wanted to do that. So what I got for you guys, be careful, be safe, watch the clock. I'll see y'all tomorrow.